Hello and happy new year. If you're anything like Austin and I, you probably spent the remainder of 2022 recharging and mentally strategizing for 2023. And hopefully you took the time to put some of those thoughts to pad. What we'd like to do today is to have a conversation around financial organization. We thought that this would be a great way to kick off the new year, arm you with some actionable items that promote financial organization and overall a smoother path to financial independence. We'll also delve into the benefits of establishing and maintaining a comprehensive financial plan, touch on some of the highlights from the Secure Act 2.0, and hear from Austin about some things to consider around estate planning at the onset of the year. Let's get started.
All right. So we all know that every year, most of us like to start our January off by proclaiming a resolution or two as an effort to make some measurable improvement from how we ended the previous year. And some resolutions may be more common than others, like going to the gym more, reading at least one book a month, or being more patient with your in-laws. But one area that is easy for a lot of us to delay and put off, even in the new year, is achieving an elevated sense of peace by taking proactive steps to plan and organize efficient personal finances, which is a big part of the reason Wes and I enjoy doing what we do for a living. Because what it all boils down to is simplifying complex financial situations for individuals and for families. Through years of experience, I've found that no one is exempt from the chaos that an unorganized financial life brings. And what better time than the beginning of the new year to take the time to sort out your financial affairs? The benefits alone are reason enough, and I'm talking peace of mind, reducing the burden on your family once you're no longer here, and most of all, building a robust roadmap that leads to financial independence. And all of this personal financial organization is accomplished through several ways. One being a financial plan, which we're going to discuss in a moment. Two, being insurance coverage that prevents a hiccup from becoming a catastrophe. Three is an estate plan that articulates how you want your assets to pass upon your death. And four, safekeeping your most important personal documents, meaning your tax returns, any legal contracts, previous insurance claims, and current declaration pages, or your basic proofs of identity. So, bearing all of these concepts in mind, Wes, I want to hear your thoughts on how our listeners can start their new year off on the right foot by establishing and maintaining a comprehensive financial plan.
Thank you, Austin. It's a great segue. First, let's take a step back for clarity. If you think of each person's individual path to wealth or financial independence, there are three identifiable phases to the process. First is the accumulation phase. This is when money is being earned, saved, and invested. Looking at this stage in a vacuum and considering whatever expenses there may be will give us a theoretical outcome of what assets could look like at any point in the future. The issue here is the vacuum, because in reality, there are several different risks that could adversely impact that outcome. The second phase is about preservation. How do you maintain and grow what you have earned and saved so that you can eventually use that nest egg for future lifestyle and or philanthropic goals? And the last stage is the distribution phase. This includes funding retirement, efficiently passing assets to heirs, minimizing taxes, and maximizing retirement benefits. What a comprehensive financial plan does is compile all these steps into one living document. I like to refer to it as a roadmap. It considers each stage of wealth accumulation, preservation, and distribution, and includes considerations around taxes, retirement, insurance, estate planning, investments, and even college savings. So, in a nutshell, a comprehensive financial plan deeply impacts your ability to reach your desired destination. Now, let's switch gears and delve into some of the highlights of the Secure Act 2.0, which was intended to be an upgrade to the Secure Act of 2019.
Thanks, Wes. So there's one particular asset class that hits the accumulation, preservation, and distribution phases with equal importance. And that asset class is your tax advantaged retirement investment savings and accounts. Now, some of you might remember that Wes and I talked to you about this last month, particularly about these investments and these accounts. And just, to give us a quick plug, we think it's a pretty informative presentation. And if you haven't checked it out yet, or if you did and you already need a refresher, you should give it a listen. But as Wes said, since the airing of that presentation, a new law was enacted on December 29th, 2022, that directly impacts how these investments and accounts are administered and operated going forward. And it also builds on the provisions that were already set out in the Settling Every Community Up for Retirement Enhancement Act of 2019, which we're going to refer to affectionately for the rest of today's discussion as Secure 2.0.
And so from a 50,000-foot view, the Secure 2.0 seeks to address the following goals. One is expanding retirement coverage and increasing retirement savings. Two is ensuring the preservation of retirement income. And three, simplifying and clarifying the retirement plan rules that will remain in place along with the updated rules that take effect in 2023 and beyond. But even though Austin and I have reviewed in detail the enacted changes in Secure 2.0, a full review of each and every change is beyond the scope of today's discussion. Instead, we will highlight a few of what we think are the most important updates. Of course, any listeners wanting to explore this topic further should reach out to their Westwood advisor to learn more about these recent changes.
So, as much as we would love to take up the rest of your day going through all of these new ins and outs that are set out in Secure 2.0, Wes and I have managed to highlight the following updates to how retirement accounts and investments will be administered going forward, which will ultimately influence the overall scope of your financial plan, since, again, all three of the phases Wes mentioned are indicated when planning for your retirement accounts. So the first highlight is Secure 2.0 updated a number of the various withdrawal and required minimum distributions, or RMD amounts, that govern these accounts. The second big highlight is Secure 2.0 updated the catch-up contribution limits for 401ks and IRAs. The third update is Simple Accounts, which stands for Savings Incentive Match Plan for Employees, and SEP Accounts, which stands for Simplified Employee Pension, now have a Roth option.
And to continue, fourth, beginning in 2024, account holders will be permitted to make 529 plan to Roth IRA transfers, which are subject to a maximum lifetime total transfer of $35,000 and a number of other rules and limits. Fifth, beginning in 2024, surviving spouse beneficiaries will have the additional ability to elect to be treated as the decedent for RMD purposes. And sixth, Secure 2.0 made several important updates to an account owner's ability to make qualified charitable distributions, or QCDs for short. And again, this is an area that is teeming with rules, exceptions, and limitations, a number of which have undergone changes both in 2019 and again in 2022. And while we prepared today's discussion to be a brief summary, please take this as yet another opportunity to engage with your Westwood advisor as part of your New Year's resolutions.
Good suggestion, Wes. All right, so let's take a little bit deeper of a dive. The biggest update brought about by Secure 2.0 is without a doubt the increase of the age during which RMDs, or required minimum distributions, are set to begin. Now, as some of you probably already know, RMDs are the minimum amounts that the IRS states that you must withdraw from your 401ks, IRAs, and other designated retirement savings accounts each year. And beginning on January 1st of this year, 2023, the starting RMD age has been bumped up to 73 from age 72. And it gets even better because Secure 2.0 is going to make another increase to the starting RMD age again to 75, but that doesn't take place until 2033. So just to give you an idea of the scope of this change, the original Secure Act back in 2019 increased the age for RMDs from 70 and a half to 72. This gradual increase of the RMD age to 75, again in 2033, is a significant benefit for impacted account owners, because this means those account owners get that many more years for their retirement accounts to grow and earn additional compound interest before the incremental depletion that is caused by RMDs.
So what does this mean to you? Well, if you were born between 1951, that is, you're at least 73 years old or older, then this update has no impact on you. If you were born between 1951 and 1959, meaning you're between the ages of 64 and 72, then your RMDs must start distributing beginning in April after the year you turn 73. Also, if you're going to turn 72 in 2023, then you can choose to wait and take your first RMD by either December 31st or of 2024, I'm sorry, or delay your initial RMD until April 1st of 2025. But if you delay until April of 2025, then you'll need to take a second RMD for the same year by December 31st of 2025. Finally, for those born on or after 1960, meaning you're 63 years old or younger right now, then your RMD must start distributing beginning in April after the year you turn 75.
So, Wes, I'm going to put you on the spot here for everybody today. What's your RMD age looking like under Secure 2.0?
I'm I'm gonna luckily I won't have to start taking those until 75. Maybe it'll be later if we get another update.
That's incredible. Good for you. And you know what? Me too. Full disclosure, we're all being honest here. All right. We're going to take it a little bit deeper now. There are two other changes under Secure 2.0 that impact withdrawals and RMDs as well. This first additional change to mention, and again, as we discussed this past December, all 401ks and IRAs are subject to RMD rules other than a Roth IRA. But beginning in 2024, 401ks and other employer-sponsored retirement plans with a Roth designation will not be subject to RMD rules while the account owner is still living. So yet again, this is another opportunity to allow those retirement accounts to continue to grow and earn that additional compound interest rather than dipping into that principal by taking those required minimum distributions.
The second change involves the penalties assessed by the IRS against account owners who do not take their RMDs. Prior to Secure 2.0, the 50% penalty assessed by the IRS for the amount not taken out of an account owner's RMD for that applicable year were harsh, to say the least. However, beginning in 2023, Secure 2.0 has reduced this penalty from 50% to 25% of the amount not taken out on an account RMD. IRA account holders will also have the additional ability to reduce that penalty even further to 10% if they correct their mistake in what they consider a timely manner.
All right. So another big Secure 2.0 change we want to highlight today involves catch-up contributions. Now, again, as we discussed this past December, for IRAs in 2023, the maximum contribution amount is $6,500 with an additional $1,000 catch-up contribution if you're 50 or older. And for 401ks, 403bs, and most 457 plans in 2023, the maximum contribution amount is $22,500 with an additional $7,500 catch-up contribution, again, if you're 50 or older. Now here, Secure 2.0 has added a special catch-up contribution limit. It begins in 2025, and it's only for employees who are aged 60 to 63, and it only applies to 401k plans and other employer-sponsored retirement plans. And this special catch-up limit will be the greater of $10,000 or 150% of the then current catch-up amount. I know that's a lot of gobbledygook. We've tried to set this out here on a slide, so we've got that detail there. But to illustrate, if this special catch-up contribution limit was in effect for 2023, any employee that is age 60 to 63 in this current year would be able to make a catch-up contribution to their 401k in the amount of $11,250. Now, how did I get to that? That math, that is going to be 150% of the 2023 $7,500 catch-up contribution limit that I previously mentioned. And that is on top of the standard $22,500 contribution limit for 2023, which when you add those two numbers together, you get a total contribution amount of $33,750 for 2023. But again, this is just for illustrative purposes. This does not kick in until 2025.
That's a big deal. Thanks, Austin. Another change here under Secure 2.0 is that beginning in 2024, the IRA catch-up contribution limit will be indexed for inflation, which finally addresses the fact that this amount was the only catch-up contribution limit that was not automatically indexed for inflation under prior law. Another change beginning in 2024 stipulates that all catch-up contributions for employees earning over $145,000 during the prior year must be deposited into a Roth account.
And speaking of Roth accounts, simple accounts and SEP accounts now offer a Roth option for contributions which up until 2023 was not available for these account types. And similar to the special catch-up contribution limit we just touched on for 401k plans and other employer-sponsored retirement plans, Secure 2.0 has added a special catch-up contribution amount for simple IRA or 401ks. Again, only going to take effect in 2025. And again, this is only going to be in effect for employees that are age 60 to 63 at that time. And that amount is going to be set to the greater of $5,000 or 150% of the then current catch-up amount. Now, before that change takes effect, and as a quick reminder from our discussion last month, the 2023 contribution limit for simple IRA and 401ks is $15,500 plus a catch-up contribution limit of $3,500 if you're 50 or older. So that's another big bump that is brought to you by Secure 2.0. Now, another item impacted by Secure 2.0 is 529 plans, which for those of you who may not be familiar, 529 plans are state-sponsored, tax-advantaged savings accounts that can only be used to pay for higher education expenses unless you want to get hit with a 10% penalty for any non-higher education expenses.
So Secure 2.0 provides a workaround to this penalty beginning in 2024 by now allowing 529 account holders to roll the plan's funds into a Roth IRA. This rollover is subject to a lifetime maximum of $35,000, like I mentioned before, and the amount rolled over each year can't be more than the applicable year's Roth contribution limit. The account must have been open for at least 15 years, and specific contributions and earning amounts must be at least 5 years old before being rolled over.
That's right. And that's a huge new benefit under Secure 2.0. And yet another change from Secure 2.0 is a new post-mortem election for surviving spouses taking effect in 2024. A couple of conditions apply here. One, if you've got an employee spouse who dies before they ever took their first RMD, and you also have a surviving spouse of that deceased employee, and that surviving spouse is the designated beneficiary of the deceased employee spouse's retirement plan, then the surviving spouse may elect to be treated as the deceased employee spouse for RMD purposes. And this is yet another important change that allows surviving spouses the ability to defer any RMDs until the surviving spouse reaches the deceased spouse's RMD age.
Correct. However, if the deceased spouse dies after taking their first RMD and the surviving spouse is the designated beneficiary of the deceased spouse's retirement plan, then the surviving spouse's only option to defer the RMD is to roll over the deceased employee spouse's retirement account balance to the surviving spouse's own IRA. If the surviving spouse does not elect to roll over under this scenario, then deceased employee spouse's RMDs will continue to be made without any deferral option. And consequently, the surviving spouse misses out on a planning opportunity for the deceased spouse's retirement account to grow and earn that additional compound interest that Austin talked about before, and depleting the account by the RMDs.
All right. Rounding the corner here to our final Secure 2.0 change we'd like to highlight today, and that's going to focus on qualified charitable distributions, or QCDs for short. Now, as we covered back in December, QCDs are an income tax-free way to transfer funds from your IRA to a qualified charity. And the basic rules for eligible QCDs, like the minimum age threshold being 70 and a half and the $100,000 per person per year cap, those remain unchanged. But that maximum $100,000 QCD amount is actually going to be indexed for inflation beginning in 2024.
And beginning in 2023, participants now have a one-time ability to fund a charitable remainder unit trust, or CRUT, a charitable remainder annuity trust, also referred to as a CRAT, or a charitable gift annuity, or CGA, not to exceed a maximum amount of $50,000. This new planning opportunity is, of course, subject to several limitations. For example, one, the charitable entity may be funded only by QCDs. Two, the income beneficiaries of the charitable entity may only be either the IRA owner and the IRA owner spouse. Third, all CRUT and CRAT distributions will be classified as ordinary income to the lead beneficiaries. That means the IRA owner and the IRA owner spouse. And fourth, the CGA must begin making distributions within 1 year of funding and must be at least 5% of the CGA's value. So while there are a lot of new rules to follow here, this could be an advantageous technique for individuals with charitable goals in mind for their planning purposes.
Okay, well, just when you thought it couldn't get more exciting talking about new law, I think we found a way to dial it up even more and really just crank the excitement here. And we're going to talk to you now about getting your taxes organized as yet another wonderful New Year's resolution for all of us. And this week is exciting in of itself because this year's tax season officially kicked off just this past Monday on January 23rd. That's right. So that's the date on which the IRS began accepting and processing 2022 tax year returns. The big one being, of course, individual income tax returns. Wes, I'm sure you got yours already prepared and filed, right?
Almost.
Almost working on it. Okay, maybe it's like a weekend to do. All right, but that's the one that I'm sure is looming in all of our minds. But there's several other returns that must be prepared and filed during the season as well, like gift tax returns, partnership and S corp returns, C corporation income tax returns for the corporations that are on a calendar year filing status, and most trust income tax returns, to name a few. We're not going to get into all the nuts and bolts on those, but just wanted to let you know that that is what is included in this season. And another heads up is that more than 168 million individual income tax returns alone are expected to be filed. And the IRS has already hired more than 5,000 new telephone assisters and added more in-person staff to help support taxpayers this year. And I'm sure it's just going to be a smooth experience for all of us, because if there's one thing we know about the IRS, it is prompt, smooth, efficient service at all times.
Very true. And please note that for most returns, the due date this year is going to be Tuesday, April 18th, instead of the usual April 15th. And this is because the weekend in the District of Columbia's Emancipation Day holiday, which falls on Monday, April 17th. Taxpayers may also request an automatic 6-month extension to file, but not to pay, until Monday, October 16th, 2023, if necessary. However, the due date for partnership and S corporation returns is Wednesday, March 15th, or Friday, September 15th for taxpayers utilizing the automatic 6-month extension to file, but again, not to pay.
Yeah, it's a very important distinction, and one that we should all be taking note of if anyone is intending to file that extension this year. Now, another item that we summarized in November of 22 is some adjusted for inflation amounts that could be critical for some estate planning techniques in 2023. So this year, the lifetime gift, estate, and generation skipping transfer, or GST, tax exemption is going to be bumped up to $12,920,000 per person. And in addition, the annual gift tax exclusion amount is going to be increased for a second year in a row to $17,000 per donee.
So increases by the IRS to these thresholds are common, but the increases for 2023 are notably larger compared to recent years. Specifically, the gift, estate, and GST tax exemption increase for 2022 was only an additional $360,000 per person compared to the additional $860,000 per person for 2023. And for the prior annual gift tax exclusion amount of $16,000 only lasted for 1 year compared to the annual gift tax exclusion amount of $15,000, which remained in place from 2018 through 2021.
So what does that mean to everybody? Well, these increased limits are huge opportunities for individuals that are seeking to reduce or even avoid their exposure to gift taxes during their lifetime, or estate taxes at death, and GST taxes, which can be imposed both during life and at death. And keep in mind that under current law, these exemption amounts are scheduled to revert to approximately $7 million beginning on January 1st of 2026. But there's a variety of estate planning strategies, including but not limited to grantor retained trusts, charitable remainder trusts, charitable lead trust, and irrevocable life insurance trust, to name a few, that individuals can utilize now to lock in the higher exemption amounts available to them and will remain available to you all through the end of 2025 before those higher exemption amounts revert to drastically lower amounts under the current law.
That's exactly right. And as we wrap up today's discussion, we want to impress on everyone that time is of the essence when it comes to your tax and estate planning in 2023. Your CPAs and other tax advisors are about to become incredibly busy for the next couple of months. So being a proactive client and providing all requested tax information as soon as reasonably possible will go a long way to ensuring that all tax deadlines are met. And regardless of your planning goals, scheduling regular reviews with your estate planning attorney is critical to making sure that your estate planning goals are clearly drafted and accurately reflect your objectives. Whether it be a relatively simple gift of tangible personal property or a complex series of gifts to an expertly drafted trust with the intention of reducing your estate tax exposure at death. And when in doubt, always remember that your Westwood advisor is here to help you navigate the planning process.
That's right. And with all of that being said, that concludes our discussion today. And so Wes and I want to thank everyone for attending and listening in. 2023 is set up to be an exciting year for individuals and their planning, all of their goals and objectives for themselves and their loved ones, and the various laws that surround this area, as we pointed out, are dynamic and constantly evolving. Fear not, taking a proactive approach and involving your planning professionals and other advisors with your affairs will help you stay abreast of the latest developments, as well as keeping an eye on how the latest laws might impact your overall planning strategies. And keep checking back with Wes and me every month while we highlight the planning and investment areas that we think will impact individuals the most. In the meantime, we thank you all for your time today, and we wish everybody a happy new year.
Happy New Year, everyone. Thank you.